Have you ever looked at a stock that's been tanking, I mean, really underperforming, and wondered, why are analysts still saying buy? It's like finding a dented car that mechanics are raving about. Today, we are diving into exactly that kind of puzzle with Frasers Logistics Commercial Trust. This Singapore-listed real estate investment trust has seen its share price drop significantly this past year, badly trailing its peers and the broader market. But surprisingly, most market analysts are shouting buy. What's going on? Is this a classic case of market misjudgment? Or are the experts seeing something we are missing? Let's break it down. If you haven't already subscribed to our channel, please subscribe to our channel. Your support truly makes a difference, enabling us to produce more stock and fundamental analysis content. But first, a quick disclaimer. Please note that the content presented in this video is for informational purposes only and does not constitute investment advice. We strongly recommend that you seek proper guidance from a qualified financial advisor before making any investment decisions. First off, what exactly is FLCT? Imagine a massive landlord that owns 114 high-quality properties worth a whopping 6.8 billion Singapore dollars. But it's not just any landlord. We are talking about a mix of modern logistics and industrial warehouses, plus some prime commercial buildings. These aren't just in Singapore, they're spread out across Australia, Germany, the Netherlands, and the UK. So, a truly global footprint. Now, for the elephant in the room. As of mid-July 2025, FLCT's share price is around 0.850 Singapore dollars. And over the last year, it's dipped by about 14 to 15%. To put that in perspective, the overall Singapore market actually gained nearly 20% in the same period. So, FLCT has really lagged behind. You might be thinking, ouch, why would anyone touch that? But here's where it gets interesting. Despite the slump, analysts have an average price target of 0.994 Singapore dollars, which is a huge 17% upside from current levels. And some estimates suggest the stock is trading roughly 13% below its true intrinsic value. That's a pretty big disconnect, right? The experts believe the market is overly focused on some short-term issues, things like lower cash payouts to shareholders, known as DPU, and the pain from rising interest rates. They think the market is missing the bigger, long-term picture. So, what is this bigger picture? Let's peel back the layers. First, FLCT's core business is surprisingly robust. Think about the properties themselves. Its logistics and industrial segment, which makes up over 70% of its portfolio, is nearly fully occupied at 99.6%. That's incredible in any market. And they're consistently signing new leases or renewing existing ones at higher rents, sometimes 8% to 19% higher. That means businesses want these properties, and they're willing to pay for them. Now, you might be asking, if things are so good, why is DPU going down? Great question. This is key. The DPU has dropped, not because the properties are performing badly or tenants are leaving, but mainly because FLCT's finance costs have surged due to higher interest rates. Imagine your household income is steady, but your mortgage payments suddenly jump. That affects your disposable income, right? It's similar here. Plus, they're choosing to pay management fees in cash, which, while reducing immediate DPU, is actually a smart move to strengthen their balance sheet in the long run. So, it's a cost issue, not an income issue at the property level. Second, FLCT is strategically transforming itself. They're actively selling off some of their commercial properties, especially those facing challenges like higher vacancies. And they're using that money to buy even more of those high-performing logistics and industrial assets. Their goal? To increase their focus on the robust landy segment to a long-term target of 85%. This is like a smart investor trimming their weaker stocks and doubling down on their winners. And get this, they have a massive right of first refusal pipeline from their sponsor, Frasers Property, valued at over 5 billion Singapore dollars. This means they have a first pick on a huge pool of high-quality properties, potentially doubling their portfolio without having to fight for them in competitive markets. That's a huge competitive advantage for future growth. Finally, their financial health is solid. Their debt level, or gearing ratio, is healthy at 33%. That's actually lower than many of their peers, giving them a lot of room to take on new projects and acquisitions. And here's the cherry on top. The macroeconomic environment is starting to shift in their favor. Analysts are predicting that interest rates in Singapore are likely to gradually ease throughout 2025. This is huge. Lower interest rates mean lower borrowing costs for FLCT, which directly translates to higher distributable income and a potential recovery in those DPU payments. Plus, the logistics real estate market in their key regions is showing signs of stabilization or steady growth. It's like the storm clouds are starting to clear for REITs. Now, no investment is without its bumps in the road, and FLCT does face some challenges. They're exposed to currency volatility, especially with the Australian dollar and euro, which can impact their reported earnings. They also have some persistent vacancies in certain commercial properties, like Alexandra Techno Park in Singapore, which they're actively working to fill. And their credit rating outlook was recently revised to negative by S&P, reflecting concerns about higher leverage amid high interest rates. These are definitely things to keep an eye on. But considering all this, FLCT is currently trading below its book value, and it offers a pretty high dividend yield of over 7%. So, what's the big picture? While FLCT has seen a dip in its share price, much of it seems to be driven by temporary macroeconomic headwinds, particularly interest rates. Its core business, especially in logistics, remains incredibly strong, and management is actively reshaping the portfolio for long-term growth. The potential for declining interest rates could significantly boost its financial performance. Now, it's crucial to remember, this video is not a recommendation to buy or sell any stock. The information shared is based on provided sources for educational purposes, and you should always do your own thorough research and consult with a financial advisor before making any investment decisions. Markets are unpredictable, and past performance is not indicative of future results. So, given all this, what do you think? Is FLCT a hidden gem waiting for interest rates to turn, or are the market's current fears justified? Let me know your thoughts in the comments below. If you found this breakdown helpful, hit that like button, share it with a friend, and don't forget to subscribe for more insights into the financial world. Thanks for watching, and I'll see you in the next one.